Hey guys, Nick Kellar, Atlas Premier Realty, coming to you with another video blog. Today we're with Matt Nader from afar due to this lovely pandemic that we're in. We really wanted to shoot something here to talk about something that's been coming up here with some mutual buyers that we're working with, and I guess questions and misnomers around credit that we wanted to dispel. And then if you guys hang tight with us, we're going to get into what we're seeing in the mortgage end of the market and how COVID has affected that or hasn't affected that. So we'll jump right into it. So Matt, we had a mutual client, set the stage here. We had a mutual client that had been monitoring the credit, thought it was one score, but it really wasn't. And then had some of their thoughts as to what impacted their credit, which turned out not to be totally true. So why don't we talk about monitoring credit?
Sure, absolutely. Thank you for having me again today, Nicholas.
Of course.
Thanks. I actually like these videos when I'm next to you, but
we're doing the best we can.
Okay. All right. So I get a lot of calls. To talk to a lot of people that they say just that. Well, Matt, I have a Credit Karma app, for example. I think that's probably the most prevalently used. I have the Credit Karma app, and it says that my credit scores are a 780. So Credit Karma app probably, what ends up happening is the Credit Karma app does show actually higher credit scores than what we have to use for qualifying a mortgage. The reason being is the Credit Karma app has what's called, it's an advantage score. It's an advantage scoring is the way that it's done, compared to what we have to use through what's Fannie and Freddie, the government agencies that essentially underwrite and yield mortgage underwriting guidelines. So the difference is that when we as a lender pull credit, we're pulling credit as what's a FICO score, not an advantage score. So that's really the biggest difference is, and I've seen pretty drastic disparities. I've had clients snapshot their Credit Karma app and say, look, it says 780, you just pulled it and it's a 715. And that's contingent upon what type of...
Well, I'm sorry, but that's important because it can change the terms that they think they might be able to be eligible for, right?
That's exactly what I was going to say. Yeah, it's contingent upon what type of financing they're pursuing. A 780 credit score down to a 716 credit score, it's going to yield a drastic difference in pricing in regards to the mortgage interest rate. And if you're putting less than 20% down on a conventional loan, it really skews the mortgage insurance. So whether you're paying it upfront or on a monthly basis, if there's that gap of where the credit scores we think they are compared to where they actually are for the models that we have to use, it's a really big difference in pricing.
What's the way to go about that? Go around that? Because I know that some people are nervous to have their credit pulled by a lender formally because they think that it's going to be a detriment. It's going to ding their credit score.
If you're having your credit pulled by individual lender, it's not going to negatively impact your credit scores. It might drop your score a point or two. But with that being said, for example, the client that we just went through a couple of weeks ago, if I could have pulled her credit and his credit 30 days prior to us writing a contract, I could have then taken that where they actually were on my side compared to where they thought they were via the Credit Karma app. In 30 days, I could have helped them get to where their actual Credit Karma score was. So the way I look at that is, it's advantageous to start with the lender up front. Yes, it will probably drop your score a point or two, but if we have the ability to improve your score 40 or 60 points, that 1 point downturn is well offset by what we can work on to increase the credit scores.
And you're insured to get better terms, probably a better payment, and save some money in the long run. So that it's absolutely no lose situation there. And then also too, what about how a lot of people think that just having open lines of credit with no balances on it is good for their credit, but that's actually not true, right?
It is true, actually. So if you have credit cards that you're not using, right? So it's an old department store card. If it has a zero balance and it has a $3,000 high limit on it with a zero balance, it actually is helping you. right? So what it's doing is, for lack of better terminology, it's showing the credit modules and how that credit is derived, credit scores are derived. It's showing the modules that, yes, I have this line of credit that I could use, but again, for lack of better terminology, I'm not abusing that line of credit.
Right.
So
it's better than
really
closing.
the best, better than closing them. Yes, because when you close them, then that's less credit that's available to you that you're either utilizing or not utilizing. So it's actually, if you have 10 credit cards, like I have a couple credit cards, but I really only use one credit card.
Right.
So I've left my other credit cards open, and they're always a zero balance. But what it's showing the modules is, well, I have X amount on these lines of credit, but I have zero balance on it. And then the one credit card that I do use, and this is very important, the one credit card that I do use, I pay my credit card bill every Monday morning. And there's a reason to that. The reason I do that is revolving credit or credit card debt is when your credit card cycles and your credit card closes on a month, a monthly statement is generated. Whatever the amount left on that credit card at that time, that's what gets reported to the credit bureaus. So a way to use your credit card, but to improve your credit scores, is either 3 or 4 days before your credit card closes and cycles, make a lump sum payment. So what gets reported to the credit bureaus, that balance is a lot lower than what you actually utilize during that month.
Right.
And or just pay it like I pay mine every week. So the reporting balance when my card cycles or closes is much, much less than what my wife actually spends on a monthly basis.
Had to throw that in there. Mindy, watch this. We won't say this to her. Awesome, man. So this is increasingly important, and why you want to talk to a lender up front is to know exactly where your credit is, so that if there can be changes or improvements to be made to it, you can have a plan of action. But also too is you kind of know what's going into impacting, and maybe some strategies on how you can impact it and increase your credit before you're actually ready to pull the trigger. That's what we had for you today. If you guys have any questions on credit or how that impacts you, or pre-approval or anything financing wise, please let us know. We're happy to help. Always appreciate the support. Hope you and your families are staying safe. We'll see you next time.